In this video, we're going to talk about knowing when to go against the crowd in trading. Stay tuned. Hey traders, a very warm welcome to you. Okay, so knowing when to go against the crowd. Here are my thoughts on it. As always, comments below, let me know your thoughts on it. There's no right or wrong to this, as there isn't with any type of trading. Okay, so what do I mean by crowd? So there's a couple of things to think about here and to distinguish is that you have a lot of different participants in markets. You've got your retail guys and then you've got your institutions, okay? And these are the ones that are moving the market. If you're talking about currencies, if you're talking about indices or big stocks, these are retail guys are irrelevant. These are the big players. So if the crowd is long on euro, US dollar, or whatever, and it's a retail crowd, it doesn't matter so much because there's such a minuscule amount of it. Most of them aren't even influencing the underlying market anyway, because the broker's taking a two-sided thing, apart from Intertrader, which will hedge everything in the underlying. But normal brokers will take in both sides of things, and it doesn't make a problem. It doesn't influence it, should I say. Okay, but there's two things that we can consider here. Number one is when our retail a big player in it. They are a big player. This is just an example. We'll go to another one in a second. In small stocks. Now, I've done a lot of study on this because I've been trading the small stocks quite aggressively for the past few years in a specific strategy. And we're going to move on in a second to institutions and how it will affect your currency trades if you're a currency trader. So hang on for the end of the video for that. But I just want to talk about this. When retail guys are trading small stocks, institutions aren't really involved in it, or if they are, they're investing, it's tucked away, they've forgotten about it. However, the retail guys, the guys who are trading from offices or home, your average trader like you and I are trading these things, causing these smaller cap stocks to rise. And I did a couple of studies myself, not very scientific, but enough for me to get a good handle on what's going on. And I would watch social media, okay? And I would watch people buying these stocks during the day intraday, and these stocks will be going up 5, 10, 6%, 7, 10, serious moves, even 20, 30% moves on stocks like biotechs, these kind of stuff. And you would see social media, people writing with their hashtags or whatever of the stock, or the dollar sign of the stock, saying, yeah, I bought more, I bought this, I bought that, and the price would be going up and up and up and up and up. And then you would just see, price will start to fall down again a little bit, and it would go quiet. And honestly, this was such a common occurrence. This would be full of people saying this is going, they feel comfortable saying how much they've made in it. They're comfortable saying this is going even further. There would be a spike in it. And it would almost be like it's the flush, as the last of the buyers are in, and then it starts to turn. And then it would just be like tumbleweed. Honestly, this would just go quiet as it fell down. Actually, that's not quite true. As it fell down, it would be quicker and quicker, and people say, I'm buying more, I'm buying more, I'm buying more. This is just a dip, I'm buying more. And you'd have all this bravado and stuff coming in. Then you'd hit the sweet spot where it would just go completely quiet. It would go completely quiet here. Your social media would stop running through, nothing would happen. People would just disappear, and this thing would just go into free fall. And that would be a beautiful short opportunity if you could get the shares to short. What's the point in this? The point is, when the crowd is on one side, there's no more buyers to be involved. For something like a small cap stock, you have to have a constant flow of buyers for it to keep pushing up. You don't have that general two-way flow that you do with a currency pair. Small cap stock, you have to have this chug of buyers, and they get giddy, they get so excited. But then, of course, when the last buyer's in, there's no external buyers coming, and all you've got are those guys who are seeing the price fall, who now turn into sellers, and there's your opportunity. So what's the point in that story? Because I know a lot of you just trade currencies or indices or the majors, which is fine because this is a different strategy altogether. The point is that when we look at the crowd per se in something, we need to look at who is actually the crowd. And a crowded trade would be a lot of institutions who are long a specific pair, or a longer stock or a shorter stock, and we can find that out. We can go online and we can see the short interest in a stock. We can see which is the favorite stock for hedge funds. We can see, if a lot of people are positioned long on currency pairs, or institutions are long on currency pairs. And we can just see that just by doing a little bit of easy research, guys. And then you kind of get to have a feel for things like the carry trade on US dollar yen and all those kind of things that unwound, you know that a lot of the crowd are in it. Now, what you don't, back to the initial subject title, when to go against the crowd, you never go against the crowd when the crowd is in full swing. It's just, you might get it right from time to time, but there's no point. The crowd is going to drive price higher and higher and higher and higher and higher. However, knowing how the crowd is positioned in something will give you something that you can write down in your notebook. You can have it there and say, hey, I've done my research and I know that a lot of banks are long euro at the moment. I know a lot of banks are short this, a lot of banks are short Tesla, a lot of institutions are short Tesla, whatever it may be. So if I get a setup or something that gives me an opportunity to take the opposite side and price action is matching that, it's a double whammy. It's like the whole trap short thing, guys. If the crowd is shorting something, heavily, Weight Watchers was a great example. Stock, massive amount of people thinking it was going to die, and it looked awful. The price kept going up and up and up, and then it just started going to the moon because all these people were having to cover shorts. That is when you go against the crowd, because you can see that there's still a lot of people who have to get out of it. The crowd is short, the price is going the other way for whatever reason. That's going against the crowd. Watching when everyone was thinking US dollar JPY is going to break through 100, and they're positioning, everyone's positioning, then it starts to rip the other way. You're going against the crowd. So my kind of take on this is, don't just blindly go against the crowd. Wait until, mark it down, have it, be prepared for it. Be prepared and say, hey, this looks like a lot of people are skewed in one direction. A lot of people are very bearish on Twitter or Snapchat or stock or whatever it may be. You could put gold in there, you could put Bitcoin in there, you could put this, that, bullish, bearish, whatever. It does look like it's skewed. There's not really a two-way kind of flow here. It looks very, very skewed. So if the price action would dictate that perhaps we're going to get a reversal from the direction we've got, I'm going to jump on it because I've got an extra reason to jump on it, because I know that a lot of people, the crowd, are positioned one way and they're going to have to unwind it. There was a case with that with Snapchat just came to my mind because it was very, very weak. Everyone's thinking it's the worst thing. And then it just popped up from earnings and had a really big rally. Subsequently, it's kind of died off, but the point is it trapped a lot of people. The crowd are all short and it popped off. Same we've had with Twitter. Actually, Twitter thing, we had a different scenario where a lot of people thought that it was going to be bought out and it was rallying up from that. The crowd was all long and of course it was a false news and it got that. So there are always these opportunities there. So while I'm not suggesting you just go against the crowd, and I'm distinguishing the crowd from the trend because it is fundamentally different, although generally it does go hand in hand. If there's a good trend, the crowd is generally long because they're buying, or the short because they're selling. So it does go a little bit hand in hand, but there's a bit of a differentiation there. Point is, guys, is that note it down, do some research, work out if you think there's a skew one way or the other, and then when your setup comes about, some sort of price action or some sort of strategy that you've got, you're adding that to it and saying, hey, I'm going against the crowd here, the setup is right and it's against the crowd, it's time to push the throttle down. So anyway, guys, that's a kind of opening how I perceive it all. Let me know your thoughts about going against the crowd and kind of the stuff I've talked about here. Thumbs up if you like the video and subscribe if you haven't already for more videos from me and other traders on this channel. As always, good trading, take care, see you in the next one, bye-bye.